Hi class, Dr. Scott here at your service. You might recognize the background. Some of you may have heard of something called Woodstock, which happened actually before virtually all of you. I'm willing to guarantee no one was around or born when this happened back in the 70s. I will confess I was 12 years old when this happened, so you can start guessing my age. It was a 3-day celebration of love, music, and all kinds of things happening in upstate New York. Well, let's get to accounting. I'm going to go ahead and share the screen, and we're going to jump over to the slide deck that I've got a few slides. We're going to talk more about some of the background of the importance of accounting, and we're going to reinforce the kind of folks that are going to use the information. We'll touch base on the Sarbanes-Oxley Act, which changed accounting as we know it in 2002. We're going to discuss GAAP, Generally Accepted Accounting Principles, which includes a bunch of assumptions, includes a framework, and we're going to again start touching on the other aspects of accounting that gives us insight into how we use this information. We're not going to get in debits and credits yet. That'll be saved for our next show, our next recording. But this one is just going to get us started, and we're going to be talking about the basics of financial accounting and giving a little bit more background information. So why is accounting important? Well, what does it do? In the last video, we talked about the use of bookkeepers for kind of recording the information and doing the data entry. But then we get into the accounting of it. And what happens? We're identifying transactions, we record them, and then ultimately we communicate that through the results, usually in the form of financial statements. So we're going to keep a track of chronological set of transactions, and then we're going to prepare financial statements to go along with that. So what kind of opportunities are out there? Who uses the information? What's going to be involved, and what kind of aspects do we need to know about? Well, on the financial side, there's a whole bunch of folks that prepare the stuff, analyze the stuff. You heard the term auditing in the last video, of which they don't guarantee the results, but it's an extra set of eyeballs by a professional that says, yeah, we think the things are right. And there's a whole bunch of folks interested in that. The managerial side, there's not financial accounting, which is more financial reporting and periodic and past performance, but managerial, which is more ad hoc reporting and current analysis to make decisions. Yes, financial might make investment decisions in companies you may want to invest in, but managerial is more operational decisions. Then there's the taxation side. And tax accountants in a corporation, 6-figure job, because you're going to be saving the company hundreds of thousands of dollars if you know what you're doing with taxes. And you can see the list of all kinds of activities. And then accounting related. And this is who the financial statements are designed for. It's the analyst, it's the investors, it's the people that are going to look at these numbers and make decisions based on those numbers. You might want to sell the company, you might want to value the company, and you're going to have somebody looking at that and saying, well, good investment, bad investment, otherwise. Or as we talked about last class, it depends. So we'll talk more about that later on. So the users, 2 categories, external folks and internal folks. So you look at and say, well, lenders, the IRS, auditors, anybody outside the company, even the board of directors are considered outside users. Shareholders are outside users. As opposed to the internal users are the managers, the employees, the staff internally. They're going to be using this information to make decisions. So it's important to get accurate information as best you can for everybody. The internal users so you can make decisions, and the external users so you can avoid lawsuits from deception, which we're in a pretty trigger-happy, litigation-happy society. So what happened in 2002, 2003 timeframe? Something called Sarbanes-Oxley Act was passed. Now, this again is no guarantee that the books are right, just like an auditor does not guarantee the books are correct. But it is a mechanism to help things along to make sure that the books are more correct. You've probably heard of companies like Enron. You may have heard of WorldCom. You may have heard of Tyco. These are massive frauds. There are massive opportunities for lying, cheating, and stealing that were out there. SOX had evolved to kind of let the financial markets give it like kind of an insurance policy to give some confidence that the information being presented by Sarbanes-Oxley through the use of Sarbanes-Oxley could be relied on. So a lot of people after Enron said, hey, they were a high flyer, cool company doing great things, and then they almost went out of business. Stock went down to nearly nothing. So that's where Sox came in. It's not the White Sox, it's not the Red Sox. I'm from Boston and I'd like to be the Red Sox, but Sox that we talk about is Sarbanes-Oxley, and you need to be aware of that. And then GAAP. What the heck is GAAP? GAAP is not the gap in knowledge between what you know about accounting and what you don't know about accounting. GAAP is what is known as generally accepted accounting principles. Generally accepted accounting principles. So these are a foundation of knowledge, and the information needs to be relevant, reliable, and comparable. So if you're comparing Ford to GM and you're looking at financial statements, if one uses LIFO, last in first out inventory, and one uses FIFO, that could kind of make the results not make them different, we'll put them that way. You also want it reliable. You want somebody else to be able to duplicate it. And you want to have enough relevant information that you can make decisions. You don't care maybe if they sold silver cars, blue cars, or white cars, but you might care how many cars they sold and how much the margins were in each car they sold. And maybe if they sold more SUVs versus minivans versus compact versus electric. You also might want to know if they sold more in the US or abroad. As you know, probably Coca-Cola sells more Coca-Cola outside the US than they do inside the US. We are in a global economy. And then there's something called IFRS, International Financial Reporting Standards. Standards, I can speak English too. International, so IFRS is in Europe, in Japan, in Canada, is what it's called. In the US, we call it US GAAP. Now, the Japanese IFRS and the Canadian IFRS and the French IFRS are a little bit different too. So the countries themselves have different flavors, but they're more consistent, and there's actually emerging, ultimately, IFRS and GAAP, the way they interpret data, the way they present data, are kind of merging and coming closer together. We're not going to emphasize IFRS or IFRS. We are going to emphasize GAAP, US GAAP. And we'll talk more about accrual accounting, which is the basis on GAAP as well. And then we have the conceptual framework. We have this pyramid that we're building. And the conceptual framework, both for the Financial Accounting Standards Board, which oversees GAAP, and the IASB, International Accounting Standards Board, which oversees IFRS, they have this conceptual framework. Contained is how we recognize and measure the transactions. And then we have qualitative characteristics that get reported and analyzed, elements that are contained, and the ultimate objectives of financial accounting. And I'm going to read out the objective aloud because this is the key to what we're doing here. The objective is to provide information useful to investors, creditors, and others. We're not making information that a 6-year-old can read, or a 26-year-old, or a 66-year-old. We're making information that an investor, creditor, or otherwise informed party can make sense of. And by the time you're done with this class, you will be at the ranks of informed parties. So congratulations. I look forward to you reaching those heights. Qualitative characteristics, relevant, reliable, comparable. Elements define what's on the statements themselves. And then there's criteria on how and when to recognize and measure the revenue side of things, revenue recognition. So if we go ahead and buy a building, can we expense that building our first year, or do we have to depreciate it? And we'll talk about reasons why and how we handle different types of transactions. And a lot of it depends, subject to interpretation. So what kind of basic principles do we have? We'll start with the measurement or cost principle. And it's based on cost. So when you buy a building, what you pay for it makes sense. I paid $100,000 for this building. 10 years from now, it might now be worth $200,000. It's downtown, and Florence downtown has come a long way. What I paid $100,000 for is now $300,000 worth. But you keep it on the books at $100,000 less the depreciation over that period of time. So you eventually, the book value of that building will be zero. And I guarantee you the actual fair market or selling value is not zero. So we're not talking about fair market value, we're talking about cost. We also have something called the revenue recognition principle. Recognize revenue when we provide service to a customer. Okay? So let's say you walk into a car dealership and you say, I like that car. And you say, there's my Ford F-250 truck. I want it. Great, I'm gonna buy it. Can the car dealer say that's a sale yet? Nope. They present you an offer and you negotiate and you say, I accept that offer. And by the way, I used to sell cars. I didn't sell Fords, I sold Chrysler, Jeep, and Kias. The car industry is a fascinating one. Happy to talk about it at any time. But, so when does that car become a sale? Well, they present you with a contract. You say, great, sign right here. Super, is it a sale yet? Nope. All right, gave a $1,000 deposit. Is it a sale yet? Nope. All right, I'm gonna pick it up next Tuesday. Cool, I come in to get it. Car's not ready, but I went to F&I, Finance and Insurance. I signed for the loan. I finished all the paperwork. Is it a sale yet? Nope. Until the title transfers on that car, it's not your car. It's not your buy or their sale. What happens if they give me a 3-day right of return, which you don't get when you buy a car at a dealership? If you buy it at a trade show, you get, there's laws about that. If someone's selling you door to door, there's laws about that. If you go to a place of business, there's no 3-day protection in case you ever were wondering about that. So you go back and maybe you bought this and you got this deal at this auto show and you committed for the car, you picked it up. Now you have a 3-day right of return. What's the likelihood you're going to return it? Don't know. Maybe 95% don't. So is it a pretty good sale? Probably. Maybe 95% of folks do. They get buyer's remorse and say, "Ups, you hard sold me at this show. I don't really want it. I'm not going to buy it." Okay. When can you recognize revenue? Important question. Expense recognition. We have this called this matching principle. We're matching revenues and expenses. That building that we're going to use for 30 years, can we expense it in the first year? Afraid not. We have to depreciate it over that 30 years, or IRS likes to say 39 years. And what's going to happen? Every year you take a little bit of expense off that building and you use it, and it's done. Utility expenses, that can be recognized right away. But if you buy a vehicle that's going to last 3 years, 4 years, 5 years, you can't expense that vehicle right away. You need to allocate that expense through depreciation over multiple years. And finally, full disclosure. Details behind the statements that would impact a user decision. So what's going on? If your company got sued for $1 million, you think you should report that under the full disclosure principle? Well, it depends. What do you mean? Well, it depends on what. If you're Walmart and somebody's suing you for $1 million, that's a drop in the bucket, right? They had $450 billion in sales. What's $1 million? No big deal. McDonald's, same thing. But what happens if that $1 million lawsuit happens to be a sexual discrimination suit, that all of a sudden they're going to make a class action, and the potential of that snowballing and now having hundreds of millions of dollars in potential lawsuits? Yeah, we should disclose that. How about if someone spilled hot coffee when you're doing the drive-thru? Should that be disclosed? Another $1 million lawsuit. Well, if you're McDonald's, again, probably not. But if you're the corner cafe, you know what? Maybe if you got $1 million lawsuit that you may be losing, yeah, you probably want to disclose that. You may not know how much you're going to lose yet, but there's a good chance you may lose that. And anybody investing in you that might buy your company would want to know about that kind of thing. So full disclosure, you got to present the information, if not in numbers, at least in what's called the notes to the financial statements. Then we have some assumptions. Basic assumptions. Let's talk about going concern. We assume we're going to be in business tomorrow, the next year, the next couple of years. It is a violation of GAAP if you're not a going concern. Right now in the pandemic, if you were going to be going out of business as a restaurant, you may not be a going concern. That is a violation of GAAP. That's not to say that GAAP doesn't get violated, but that needs to be disclosed. An auditor would have to disclose that. And a going concern, because what happens at a restaurant? You've got these kitchen stuff. You got these tables and chairs. You got these stoves and ovens. You got refrigeration units. You paid $100,000 for equipment. And if you had a fire sale tomorrow, you might get $5,000, 5 cents on the dollar. But if you used it for 10 years, you'd hopefully get the full $100,000 benefit over that 10-year period. So you have to assume a going concern. We're going to use monetary units. We assume $1. We're not using pounds, we're not using euros, we're not using Japanese yen. We're going to use dollars in our assumption and assume zero inflation. And that's kind of something to put in the back of your mind. Because if you had 50% inflation, where I took my first accounting course, I studied abroad in Israel for a year, and we had 50 to 60% inflation, that really throws a number on. Well, so our sales went from $1 million to 1.2 million. Is that a 20% increase in sales? Actually not, because the value of the dollar, in that case the shekel, was going way down. So our sales actually fell year to year based on the inflation. We assume we're an isolated business entity. We're not merging Ford and GM and all the data from Chrysler and Mercedes, Daimler-Benz, or any of the other companies. We got our own individual company. We can actually do a balance sheet income statement for the company. You probably hear some thunder in the background. We have flood warnings, kind of cool stuff, but at least I'm indoors. And so hopefully you do. Time period assumption, we have artificial time periods. Quarterly. How many months in a quarter? Well, there are 3 months in a quarter because it's 4 3-month periods in a 12-month period. But what does a restaurant do? If you're a pizza restaurant, think about it. What are your busiest nights? Well, probably Friday and Saturday. If you had a month where you had 5 Fridays and 5 Saturdays versus 4 Fridays and 4 Saturdays, do you think you'd have a better month? Well, often, artificially breaking up, restaurants will do 4-week periods throughout the year. So instead of 12 monthly periods, they'll have 4-week periods, 13 of them in the year for the same 52 weeks. So they have the same number of Fridays, same number of Saturdays, same number of Sundays, same number of Mondays. And that gives consistency. Think about it. How many days in February? Typically 28 days. How many days in January and March? 31 days. There's a 3-day difference. What's 3 out of 30? Or 1 out of 10? That's a 10% less days in February, so that if you had the same amount of sales, or you had a little bit less sales in February than you did in March, you could have a higher daily rate. So you got to play with the numbers a little bit and think about what that means and translate that. All right, different types of organizations. We're not going to get into a lot of detail, although I do want to talk about a couple of things. And I'm going to get over to a sheet here. And we'll talk about sole proprietor, we'll talk about partnerships, and we'll talk about corporations. When we look at that, sole proprietor, you hang out your shingle. Hi, Scott Dell CPA, we're good to go. Easy to set up, and it's just under your own social security number, nothing fancy. Partnership, a little more complex. You have something called a partnership agreement. With that agreement, say, okay, here's your responsibilities, here's my responsibilities, here's what we're going to be doing, and when we make money, I tell you what, you put the money in, you've got the money. I'm busted, I'm broke, but I'm going to do all the work. But we're going to split it, 60% of the profits go to you and 40% to me, whatever we agree. Even if you put up all the money, I'm putting in the sweat equity. So whatever you agree to. And what happens if one of us decides to move to California? What happens to the company? What happens to the assets? How about if one of us, God forbid, passes away? We take out something called key man insurance, kind of sexist, but the insurance will actually buy the other partner out and go to their estate and go to their families and whatever it might be. We can talk more about that another time. Let's talk about corporations. All right, we have C Corps, like a Microsoft, like an IBM, like Electronic Arts. We have S Corps, we have LLCs. The good side about a sole proprietor, it's easy. The downside is when you pass away, what happens to the vehicles you own? Well, they're usually personal, and then if you owe anybody money, they have to come after your estate. A corporation has something called unlimited life. You own shares of stock. What's going to happen? When you go ahead and something happens to you, or you want to sell your interest, you just sell the stock, and the corporation lives on. Corporation house has something called double taxation. What happens when a company makes money? Well, you have an income statement for the company, they pay taxes on that profit. And then they distribute dividends to the owners. And the owners pay taxes on the dividends. That's called double taxation. On a sole proprietor, the revenue and expenses, the net income you make, the net of the revenues minus expenses, that goes on your personal income tax, and it's a single taxation. You're not paying taxes twice. S corps and LLC get around that double taxation and form single taxation. Just corporations are a lot more to set up. You set up in the state that you reside in, and we'll talk more about in the last chapter of this class. I just want to give you a brief background, some brief insights into what that's about. And you can see here, it's a nice summary on the screen: taxation, owner's liability, the limited liability, by the way. Corporation is a cheap insurance policy. They can't sue you, they have to sue the corporation. If you buy a share of stock, a share of Google, now, well, the name is Alphabet, change its name from Google to Alphabet. You buy a share of Alphabet and there's a class action suit, you're not going to lose your house, your family, your firstborn. You're going to lose your shares of stock if they go bust and pay out everything to whoever's suing. Legal entity, business life, unlimited life, indefinite life versus the life of the owner. And those are some things to think about as you read through the chapter. Just want to introduce it here to you. And then there's a constraint: cost-benefit analysis and materiality. Cost-benefit says information which benefits greater information, the cost, start again. Information with benefits of disclosure greater than the cost need to be disclosed. So it doesn't pay really to get how many silver cars we sold, how many black cars, how many blue cars. It may pay to determine categories, and the information is easily accessible. We're not going to depreciate a trash can that we spent $5 on over 5 years of useful life, $1 a year. We're going to take that trash can, expense it in this year because it's not worth messing around. And the other is materiality. Information would influence a decision should be disclosed. We talked about that $1 million lawsuit. Is it material? Well, to a $2 million company, it's material. To a $2 billion company, it may not be material. So we make that decision, we make that choice, and you can justify it accordingly. That concludes this aspect of Chapter 1, and we're going to get into the debits and credits and creating financial statements in our next chapter, our next lecture. We have another Chapter 1 lecture that will give you some more insight. Hope you enjoyed this one. I'm available for questions if you have them, and look forward to keeping in touch. Thank you for your interest and the opportunity to serve.